Hello, is anyone there? Well, if you have questions, feel free to drop them in the chat. For the next hour or so, I'm going to go over a slide deck that talks about doing forensic financial analysis with Perplexity. And I'll give a few prompts that can help you with doing some of this investigative work. Let's see about sharing this. Okay, so welcome to this presentation. I'm John Gillespie. I'm the founder of OCCAM'S Investing. And over the next 12 slides or so, I'm going to teach you how I actually do forensic financial analysis and how I use Perplexity as a research co-pilot to do this. Now, while I am the founder of OCCAM'S Forensic Jury and OCCAM'S Investing, this is not, the methodology that we do as part of our process. But as an individual learning how to do this type of research, this is a great place to start. So I want to start with a real pattern that I've seen in dozens of filings. A company reports $2.1 billion in profit. Company in the same 10K in the same year burned $3.4 billion in cash. Both numbers are true. Only one tells you whether this is a business you should own, right? So most retail investors read the income statement, if they read anything, and they stop right there. They never reconcile reported earnings against the cash flow statement, and they almost never read the footnotes that explain the gap. So that's the gap that forensic analysis is designed to close. Forensic analysis means reading the income statement, the cash flow statement, and the footnotes together and treating the cash flow statement as the truth teller. Earnings can be engineered. Cash either showed up in the bank account or it didn't. And that's the entire foundation of how I invest. So reported profit can be inflated in 3 different ways without breaking a single accounting rule. These are the 3 lies of GAAP accounting, and it's your job to understand who's telling the truth or not. Every time you open a 10K, you need to figure out which one is hiding in the filing, right? There's 3 lies. The first lie is non-cash, quote unquote, one-time charges. Stock-based compensation, restructuring impairments, and companies will tell you to look past these because they're non-cash or non-recurring. But if they recur every single year, they're operating expenses, no matter what the press release calls them. The second lie, they're working capital traps. Earnings can rise while accounts receivable balloons and the company stretches its payables. No real cash has moved, but the income statement says it did. The balance sheet keeps receipts, and this is where the disconnect shows up first. The third lie is aggressive recognition, channel stuffing, right? Percent of completion gains, capitalized costs that should have been expensed. The 10K never lies. It just tells the truth in the footnotes that just coincidentally that most people never read. Here's where I want to set expectations about Perplexity, because most people either treat it like a magic 8 ball or they refuse to use it at all. Both are wrong. Perplexity is the best research analyst you've ever hired. It's tireless, it's fast, it doesn't have an agenda, and it will read a 200-page 10K and give you the 5 things that matter in under a minute. It's incredible at surfacing risk language changes between filings, comparing peer disclosures side by side, and pulling the footnote you'd otherwise miss. But Perplexity is not and will never be your portfolio manager. You still own the math, you verify every single number it cites, and you own the judgment about whether a divergence is benign or terminal. You own the sector logic about the valuation multiple and how it applies. You write the thesis before you estimate a price. You carry the risk of being wrong, which means you size the position. AI compresses the work. It doesn't absolve you from doing it. And another note, Perplexity has a reputation like many of the LLMs of hallucinating. So one of the things it will be your responsibility if you're using this is to write good prompts and actually insist that Perplexity, when it gives you numbers, that it gives you citations with URLs to make it a little bit easier for you to go and validate that a particular number was correct before you go and publish it. So here's 3 prompt patterns that work. The single biggest mistake people make with Perplexity is asking lazy questions. If you ask, tell me about Apple, you'll get marketing copy. The model is trained on the entire internet, and the internet is mostly noise. You have to direct it. These 3 prompt patterns return forensic signal instead of marketing copy. Pattern 1 is the disclosure difference. You ask Perplexity to compare the risk factor section across the last 3 10Ks and identify every risk that was added, removed, or softened, or strengthened. Make it quote the before and after language. You're hunting for what changed when nobody was looking, because management changes risk language for a reason. Pattern 2 is the footnote hunter. You point Perplexity at a specific topic, revenue recognition, capitalized costs, contingent liabilities, and force it to summarize every footnote on that topic with quotes. This pulls the disclosures management buried where they hoped you wouldn't look. Pattern 3 is peer triangulation. You ask how 3 companies in the same industry disclose the same thing, and you ask which one is the most aggressive or the least transparent. This makes the outlier name itself, and the outlier is almost always where the story is. So Perplexity is a great tool. It's not as well known as some of the other LLMs. So Perplexity Pro is $17 a month when billed annually, and you can get a lot of use out of it. And it allows you to select a number of different LLMs to help drive it. In some of the LLMs, they changed their functionality. I think recently Claude has been given the capability to do real-time searches on the internet, but Perplexity has been doing that for quite a while. And, it is a great tool. I recommend that you learn how to use it. And here is a story that you could test some of your prompting skills. And we have the prompt in this slide that you can just copy to the Perplexity chat and see what it comes back with. But if you're looking for trend analysis, right? So basically, imagine investing in a company that looks like highly profitable today, only to realize its core profits have been quietly shrinking for 3 years. The lesson: spotting structural shifts before they become obvious. In the headlines, the prompt: act as a forensic financial analyst, search the SEC 10Ks for a company over the last 3 fiscal years, and create the markdown table for the company. Let me switch screens and I'll actually execute this prompt so you can kind of get a feel for how it is working. Right, so this is that prompt that we saw on the last slide, and I put NVIDIA in as the company that it would run this task for, and it goes through and does all of the things that we've asked it to. If you notice this, prompting is nothing like programming used to be. You can talk into your chats in natural language, so it's pretty much in English level languages, but you have to remember it's still just a computer. It's only going to do what you ask it to do. And we'll let this finish just so that you can kind of see what it did and basically have an idea of these are the types of things that Perplexity can help you with. With OCCAM'S FORENSIC JURY, Perplexity is just one of the LLMs that we use to kind of match up to each other to look for different views and different opinions on the financial statements. So here we go. Basically, the chat finished. And it gave us everything that we had asked for, and then it came back with, was there anything here that you'd like to follow up with? And so it puts you on the trail in order to basically start to come back and find what you want to find as far as the data that you're looking for. Mm-hmm. And here's another prompt. If you run into questions, if you can't get this off the screen, if you have questions, I know that there's not a lot of people here, so feel free to send me an email. You can see that on the place where I publish this, where you can contact me with questions if you'd like more information on how I utilize this in the real world. Happy to talk to you about it. As you can see, there's lots of information that you can pull from these financial statements. And with these prompts, by changing the company name, you can grab information about any company that reports via the SEC filings. So when I do my financial statement analysis, really, cash is king. It's all about free cash flow. If a company doesn't have free cash flow, they're not going to last very long. So this is the single most important slide in the deck. I call it the divergence razor, and it's the first test I run on a company I'm considering. Net income, operating cash flow, and free cash flow should tell roughly the same story. Net income is what the income statement says you earned, but it's subject to accruals, capitalization, management judgment. Operating cash flow is what actually moved through the bank account, and free cash flow is operating cash flow minus capital expenses. That's the number that actually pays dividends, retires debt, and funds buybacks. When those numbers agree, the business is probably clean. When they diverge, somebody made a choice, and the cash flow statement always wins because cash is a fact, earnings is an opinion. Here's what the razor in a single line, right? Take the absolute value of the net income minus the operating cash flow, divide that by the absolute value of the net income. If that number is greater than 25%, you flag the company for forensic review. If you don't reject it, you just stop and ask why. About a third of the S&P 500 fails this test on any given year. And most of the time, the gap is where the actual story lives. So if you truly want to make a living investing in stocks, this is an equation that you must know. So it's a worked example. We have the three prompts, right? Company X reports 500 million on 180 million operating cash flow. The raiser's 64%. The income statement and the cash flow statement disagree by 2/3. Now you need to ask Perplexity some questions. So let me make it concrete, right? The income statement and the cash flow statement disagree by 2/3. This is a screaming red flag. The next 20 minutes is how you can turn it into a thesis. Question 1 for Perplexity is the most recent 10K. Identify every working capital movement and explain what's driving the gap between income and operating cash flow. Force it to quote the relevant footnote language. Question 2, has accounts receivable grown faster than revenue over the past 3 years? If so, by how much? And what does management say about collection terms? This is where channel stuffing and aggressive recognition show up. Question 3, show stock-based compensation as a percentage of operating cash flow over the last 5 years. If that ratio is rising, that tells you the headline number earnings number is increasing, subsidized by share dilution, which is a real cost paid for by every existing shareholder. 3 prompts, 20 minutes in, you've gone from a single number to a structured set of questions that either justifies a deeper dive or kills the idea on the spot. Killing the idea on the spot is actually pretty important before you want to put your hard-earned dollars into investments, right? So cash minus cash-based rule of 40, excuse me. So most of the growth investors use the rule of 40 as a quality screen. The classic version adds revenue growth percentage to EBITDA, that's earnings before interest, taxes, depreciation. Margin percentage, a company over 40 is considered healthy. I don't use EBITDA. EBITDA is fiction. It's earnings before all the things that actually matter. Interest, which has to be paid, taxes, which have to be paid, and depreciation, which is a real economic cost, and amortization, which represents capital that was actually deployed. Charlie Munger was famous for calling EBITDA bullshit earnings for a reason. So at OCCAM'S, we use the cash version. Revenue growth percent plus operating cash flow margin percent. Above 40, the business is healthy. Growth that isn't being faked and cash is supporting the story. 20 to 40, you're on the watch list. Growth is slowing or cash conversion is weakening. And you need to read the next quarter's statements very carefully. Below 20, the business is cash stressed regardless of what headline EPS says. If consuming more than it produces, and the prompt at the bottom is the one I run first on every name. Pull 5 years of revenue and operating cash flow, compute the score, flag every year that fell below 20. That single screen kills more bad ideas than any valuation work that I do after the fact. And we have this other thing called the zombie death clock. It's a second screen, and it's even simpler. A zombie company is one whose interest expense exceeds its operating cash flow. It cannot fund its own debt service from the cash the business produces. It survives only by refinancing and issuing new debt to pay old debt, which works fine until rates rise or credit tightens. Then it doesn't. The clock is a single ratio. Operating cash flow divided by interest expense above 5 times, the business is healthy. Interest is tightening and a small operational shock could compress even further. 1 to 2 times and you're in zombie territory. Cash barely covers that debt service. Equity holders are residual claimants on a very thin sliver. Below 1, the company is walking dead. Operating cash flow cannot cover interest, and survival depends entirely on capital markets staying open and willing to roll the debt at acceptable rates. When the window closes, and it always closes eventually, these companies don't get restructured. They get wiped out, and equity is worth zero. If a name falls on the zombie clock, I don't care how cheap the stock looks. Cheap zombies stay cheap until they die. And you can find zombies in the dot-com crash, in the financial crisis, and during COVID, right? They happen periodically, just like the economic cycle happens. And if they're happening in good times, you want to run for the hills. It's just not a company you want to be in. This slide is the one that separates serious investors from people who learn valuation from a single Oswald video. Applying a software as a service style DCF to a real estate investment trust, a REIT, is a malpractice. A REIT FFO multiple won't tell you anything useful about a bank. The model has to match the business. For most operating businesses with stable cash flows, a standard DCF, and that's discounted cash flow, works. WACC, or basically WACC, free cash flow terminal growth, for REITs, and use FFO and AFFO and net asset value per share, because GAAP depreciation badly distorts real estate earnings. For business development companies, BDCs use NAV, net asset value, net investment income, and dividend coverage. For banks, you use tangible book value, net interest margin, and efficiency ratio, and return on tangible common equity. For pipeline and master limited partnerships, it's distributable cash flow units that matter, distribution coverage and leverage at full cycle and mid-cycle multiples, or you'll buy them at peak earnings on a low PE and get destroyed. For insurance, it's book value, combined ratio, and underwriting discipline. 7 businesses, 7 models. The work isn't memorizing every formula. The work is recognizing what kind of business you're looking at before you start valuing it. Get the company right, and the model follows. So this is the full workflow, ticker to thesis in 60 minutes. The discipline isn't the speed. The discipline is the sequence. Each step assumes the previous one passed. First 5 minutes, pull the 10K, ask Perplexity to summarize it in 5 paragraphs covering the business, the segments, and the risks, the capital structure, and what changed since the last year. Minutes 5 to 15, run the divergence razor. If the gap between net income and operating cash flow exceeds 25%, ask Perplexity to explain the gap before going one step further. Don't proceed if the cash flow story doesn't reconcile. Minutes 15 to 25, run the quality screens. Cash rule of 40 and the zombie death clock. If either one is the red zone, write that down before you fall in love with the story, because once you're attracted to the narrative, you'll rationalize those numbers. Minutes 25 to 40, apply the right valuation model for the sector and triangulate against 2 peers. Sanity check every number Perplexity gives you against the actual filing. Minutes 40 to 50, read the footnotes Perplexity flagged. The footnotes you skip is the one loss that's hiding in plain sight. And it's the killer of independent judge. Anchoring is the silent killer of independent judgment. If you see the price first, you'll work backwards to justify it. Write the thesis cold, decide what it should be worth, and then look at the market and see if there's an opportunity, right? Many analysts out there, they have a price in mind, and they write their valuations to support what they'd like the stock to be worth. So before I close this slide, this is here for legal and ethical clarity. I want to take a moment with it. I'm not a registered investment advisor. Insightful Agents AI LLC is not a registered investment advisor. The OCCAM'S Forensic Jury methodology that I described a little bit is an analytical framework, a way of thinking about businesses. not a list of stock recommendations. The only company I named was in NVIDIA in the Perplexity chat, and it was for example. I do not have a position in NVIDIA. They're just to teach the method. OCCAM'S Forensic Jury is a registered trademark of Insightful Agents AI, LLC. So with that, we'll close. Follow the cash, not the noise. Numbers don't lie, the narratives do. AI just makes the work tractable. So this session went very quick. I have plenty of time in here in case there were people that had questions. When there's no questions, just like when I was teaching Scrum and Kanban classes, no questions in the classes run very quickly. When people come with questions, then it is a lot more interesting. So if you view this and you have questions, please do put comments in the chat, email me, etc. I read all the comments and I respond to everybody. All right, so we'll call that a night if I don't see anything pop into the chat box. Okay. Well, thank you for watching, and please do ask questions.